Welcome to The Explainer. Okay, let's dive right in. Today, we're unpacking the story of a space and defense company called Redwire. And honestly, it's a bit of a head-scratcher. On one hand, you see this incredible momentum, but when you look under the hood, you find some pretty serious financial turbulence. And this slide really lays it all out. It's a tale of two completely different stories, isn't it? On the left, you've got this absolutely stellar revenue growth, up more than 50%. But then you look to the right, and you see a net loss that has just ballooned to over $41 million in just one quarter. So what's the real story here? Is Redwire about to take off, or is it in a bit of a tailspin? Let's break it down. All right, let's start with the good stuff. We're going to dig into the bull case. And believe me, it is all about some seriously impressive growth and some really smart strategic moves. Wow, just look at that number, 50.7%. If you're a growth investor, this is the kind of thing that really gets your attention, right? This isn't just a little bump. We are talking about explosive growth here, which is a huge signal that the demand for what Redwire is building is just off the charts. Okay, so revenue is booming, but what about the future? Well, that's where this next number comes into play, the book-to-bill ratio. Now, this might sound a little technical, but it's one of the most important signs of a company's health in this industry. And Redwire's is looking fantastic, sitting at a very strong 1.25. So what does that actually mean? Well, think of it like this. For every $1 of work they're finishing up and billing for, they're getting $1.25 of new work coming in the door. It means the line of customers is getting longer, not shorter. That is a huge green flag for what's coming down the pipeline. And here's what all that new business looks like in real money. All those new orders are stacking up into a massive backlog. We're talking over $355 million. Now, that's not just potential business, that is contracted, locked-in work. It gives us a really solid picture of their revenue pipeline for the next year or so. But it's not just about the size of the backlog, it's about who they're working with. These aren't just any old contracts. We're talking about providing the critical solar arrays for Axiom's commercial space station, an 8-figure deal for advanced spacecraft docking systems, and being the prime contractor for a big mission with the European Space Agency. These wins are huge because they're basically weaving Redwire's technology right into the fabric of the future of space. Okay, so the growth story is pretty compelling. But there's always a but, isn't there? Let's flip the coin and look at the bear case. And this is where things get a little dicey. We need to talk about profits, or the lack thereof, and some signals from major shareholders that are definitely raising some eyebrows. And yeah, this is the number that just doesn't sit right. Despite all that fantastic revenue growth we just saw, the company's net loss more than doubled compared to last year. It went from 21 million to over 41 million. So you're making way more sales, but you're losing twice as much money. That raises some serious questions about how they're spending and when or even if this company will ever actually be profitable. And it's not just that the numbers look bad in a vacuum, they were also a huge miss compared to what all the analysts were expecting. I mean, they missed their revenue targets by over 21%, and the earnings per share, they were off by more than 100%. When you miss by that much, it really shakes confidence. It makes the market wonder if you've really got a good handle on your own business. All right, now this might be the biggest red flag of all for a lot of people. In a single month, the company's biggest shareholder, a firm called AE Red Holdings, sold off a jaw-dropping $252 million worth of stock. That is a massive amount of insider selling. So you have to ask the question, right? Why are the people on the inside heading for the exit so fast? Now look, insiders can sell for lots of perfectly good reasons, but when you see selling on this scale without any kind of prearranged plan, it's hard to ignore. It puts a ton of downward pressure on the stock price because the market is constantly having to soak up all these shares being sold. And to top it all off, there's one more thing for current shareholders to think about. The company itself has set up a program to sell up to $250 million in new stock. Now, it's a common way to raise cash for growth, but what it means for you, the investor, is that your slice of the pie is about to get a little bit smaller. It could dilute the value of your shares by as much as 10 or even 15%. So, what are we supposed to do with all this? We've got this amazing growth story on one side and some pretty scary financials on the other. It's a classic tug-of-war. To figure out which side is winning, you've got to know what to look for. So here is your flight plan for tracking Redwire's performance. Now, obviously, this isn't investment advice, it's just a framework to help you make sense of it all. First, watch their progress toward positive adjusted EBITDA. Can they get that number out of the red? We need to see that negative 2.6 million start shrinking quarter after quarter. Second, that huge $355 million backlog, is it actually turning into recognized revenue? And third, keep a close eye on the filings from AE Red Holdings. Are they still selling off shares, or has the pressure finally eased up? These three things will tell you a whole lot about where this is all headed. Look, there is no doubt that Redwire is positioned right at the heart of the new space economy. Their technology is critical, demand is soaring, and they're landing huge contracts. But, and it's a big but, they're also burning through cash at an alarming rate and facing major headwinds from investors. So the question is, will they build the future of space, or will they just burn up on re-entry? Ultimately, it's their financial execution that will decide that.
Okay, it is Tuesday, January 27, 2026, and if you've been anywhere near a market heat map today, you're seeing a lot of green in the space sector, a lot. But there's one ticker just screaming for attention.
You have to be talking about Redwire Corporation, RDW.
RDW, I mean, how can you miss it?
It's hard to ignore a stock that jumps, roughly 29% in a single day.
Yeah.
And the volume it's just as startling, over 45 million shares.
45 million. For a company that size, that's an enormous amount of liquidity just rotating through.
Massive.
Yeah, but I've been digging through the stack of sources we pulled for this. We've got the Q3 financials from 25, analyst notes from H.C. Wainwright, SEC filings, and I feel like I'm watching two totally different realities collide.
How so?
Well, on one hand, you have this euphoria, right? Massive government contracts, missile defense hype, and a stock chart that's basically a vertical line.
And underneath all that?
Underneath, it's a lot messier. You have a company that just missed earnings. You have the hangover from the government shutdown. And then this is the part that really gets me. You have insiders dumping hundreds of millions of dollars in stock.
Right, as the good news is breaking.
Exactly. It's a classic market paradox. The narrative is incredibly bullish. Space is the new high ground. But the actual financial mechanics they're flashing some yellow lights.
So that's our mission for this deep dive.
That's the mission. We're going to look past the intraday hype. We need to figure out if Redwire is really the picks and shovels infrastructure play for the new space economy, or if it's a volatile government contractor that's going to leave retail investors holding the bag.
While the PE guys walk away. To do that, we have to start with the catalyst. The reason the stock is up 29% today, we have to talk about the Golden Dome.
It sounds like a Vegas casino.
Right. But it's actually the Missile Defense Agency's new architecture. The news hitting the wires is that Redwire secured a spot on a $151 billion contract. It's called the SHIELD IDQ.
Okay, let's stop right there, because headlines love that number, $151 billion. It sounds like Redwire just won the lottery. But we need to be really precise about what an IDIQ actually is.
I'm glad you paused there, because this is where investors get tripped up all the time. IDIQ. It stands for indefinite delivery, indefinite quantity.
Right. It's not a check they just deposited. It's more like getting a hunting license.
That's the perfect analogy. The government has put $151 billion on the table. That's the ceiling for the whole program. But Redwire didn't win that money. They won the exclusive right to compete for pieces of it.
Against a handful of other vendors.
Exactly. So they have a VIP pass to the buffet, but they still have to fight for every plate of food. They bid on specific task orders.
But getting that VIP pass is still a massive deal. It's a validation.
Oh, huge. Being selected for SHIELD means the Missile Defense Agency has vetted your tech. They've decided you are a prime player for the next generation of defense.
And the analysts at H.C. Wainwright seem to agree. They're projecting the lifetime value here at over $500 billion for the industry. They're calling it a near-term transformative event.
So the question is, why Redwire?
Yeah, why them? I usually think of them as the guys building solar panels or, 3D printers for space. Why does the Missile Defense Agency need them for a Golden Dome?
It all comes down to physics and speed. The Golden Dome isn't really about shooting missiles down. At least Redwire's part isn't. It's about seeing them. Specifically, tracking hypersonic threats.
Hypersonics. The nightmare scenario. Mach 5, maneuverable.
And incredibly hard to track with our traditional high-orbit satellites. They're just too far away.
Right, if you're sitting up in geostationary orbit, 35,000 kilometers up?
Yeah, you get great coverage, but your resolution is lower, and this is the critical part. Your latency is higher. The signal takes time to travel. When you're trying to hit something moving a mile per second, those milliseconds matter.
But the only solution is to get closer. You have to go lower.
Much, much lower. And this is where Redwire's specialty in VLO, very low Earth orbit, comes into play. We're talking about altitudes between, say, 250 and 450 kilometers.
But that's a dangerous neighborhood for a satellite. There's still atmosphere there, atomic oxygen, drag.
It'll tear a normal satellite apart.
Or it just falls out of orbit in a few months if you're not constantly boosting it.
And that's Redwire's moat. They've developed platforms, you've probably heard of SabreSat and Phantom, that are designed aerodynamically to survive in that skim layer of the atmosphere.
So, because they're closer.
Their optical sensors get much higher resolution, and the data latency is basically zero. They're building the eyes of the Golden Dome that sit right on top of the threat.
And this isn't just a PowerPoint deck, right? They've already proven this technology.
Correct. They're the prime contractor for the European Space Agency's SkimSat mission. That was the big validation. If the ESA trusts your VLEO tech, the U.S. Missile Defense Agency feels a lot more comfortable cutting you in.
Okay, so that explains the explosion in the stock. The market sees defense contract, hypersonics, proprietary tech, and just smashes the buy button. But Redwire has always pitched itself as more than that.
More than just a defense company.
Right. They want to be the infrastructure of space, the plumbing and the power.
The space plumber's argument is a strong one. If we pivot to the commercial side, Redwire is really trying to be the company that sells the garage doors and the power outlets for everybody else.
Let's start with the power outlets, the ROSA technology, roll-out solar arrays.
The ones that unroll like a high-tech yoga mat.
Exactly. And they've kind of become the industry standard, haven't they?
Absolutely. They are powering the International Space Station right now. They were on NASA's DART mission, the one that hit the asteroid. But the really big forward-looking win is Axiom Space.
Axiom. They're building the commercial successor to the ISS.
That's right. And Redwire won the contract to provide the solar wings for that station. This is critical. As the ISS retires, all that activity is moving to commercial stations.
And Redwire is powering that transition.
Literally. It's a sticky revenue stream. Once you design your whole station around their power system, it's pretty hard to switch vendors.
Okay, so you've got the power outlets, then you have the garage doors, the docking systems.
The International Berthing and Docking Mechanism, or IBDM. They just landed an 8-figure deal with the exploration company for their Nix spacecraft.
I love that we're at a point in the space economy where we're talking about 8-figure deals just for parking sensors.
It sounds funny, but it's essential infrastructure. If you want to park at a station, you need a standardized, safe way to do it. Redwire is selling the click that connects you to the station.
So whether it's power or the physical connection, they are embedding themselves into the architecture of what's coming next.
And this feeds right into that SpaceX halo effect you hear about.
Explain that.
Well, investors see Starship launching, they see launch costs plummeting and volume going up. Redwire doesn't launch rockets, but they build the stuff the rockets carry. They're a proxy for volume.
So if SpaceX launches 1,000 times, those payloads still need power, sensors, docking.
Redwire benefits from the traffic, no matter who's driving the truck.
Okay, so the story is incredible. It is just so compelling. You've got the defense upside, you've got the commercial infrastructure floor, but then we have to look at the bank account.
The reality check.
The Q3 2025 earnings report. It was a splash of cold water.
It really was. Revenue came in at about $103 million, which, look, that's up 50% year over year. That's great growth. But Wall Street was expecting something like $132 million.
That is a big miss.
A significant miss. And the bottom line wasn't pretty either. A net loss of $41.2 million. They're burning cash. Even adjusted EBITDA was negative $2.6 million.
Now, management had a very specific reason for this. A very convenient reason, maybe. The U.S. government shutdown.
And it's a valid one. I mean, the shutdown froze everything. They had delays in contract awards, specifically for the Army's long-range reconnaissance drone program.
And, ironically, the Golden Dome funding was held up too.
Exactly. It just highlights the double-edged sword of being a government contractor. The checks are huge, but they operate on congressional time.
So management's argument is delayed, not lost.
And to be fair, the backlog supports that. Their book-to-bill ratio was 1.25.
And for anyone not familiar, that means for every dollar of revenue they made, they booked $1.25 in new orders.
Correct. It means the funnel is filling up faster than they can empty it. A ratio over 1.0 suggests growth. Their total backlog, $355 million. That's a healthy cushion.
So the bull case is The demand is there. The government just couldn't sign the paperwork in Q4, but it's coming.
That is the bull case in a nutshell. But this brings us to, well, the elephant in the room. The thing that completely contradicts the bull case.
The insiders selling.
If the backlog is real and this massive contract was just around the corner, why were the insiders sprinting for the exit?
This is the data point that just keeps nagging at me. We're not talking about a few thousand shares here. In January 2026 alone, insiders sold, what was it? Approximately $252 million worth of stock.
And the primary seller was AE Red Holdings. That's basically AE Industrial Partners, the private equity firm that backed them. They unloaded over 12 million shares in mid-January.
Okay, let me just push back on the panic narrative for a second here. AE Industrial is a PE firm. These guys have a life cycle, right? They buy a company, they fix it up, they take it public, and eventually they have to sell to return cash to their own investors. Maybe this is just their normal exit.
You could absolutely argue that. PE firms have a mandate to liquidate. But if that's all it was, a standard, our fund is closing, time to sell, move, why didn't they use a 10b5-1 plan?
The pre-scheduled trading plan. I'll sell 10,000 shares every Tuesday, no matter what.
Exactly. It's designed to prevent this exact kind of suspicion. It tells the market, this is routine, don't worry about it. But AE didn't use one. These sales were discretionary. They looked at the market, or maybe the internal situation, and decided to pull the trigger on a massive block sale right now.
So the lack of a plan implies urgency.
It implies they want it out immediately, rather than strategically over time. When a major insider dumps 12 million shares without a schedule, right before the good news hits, it signals they prefer the cash today over the potential stock appreciation tomorrow.
That's what's so worrying. They knew about Golden Dome. They knew about the backlog. And they still said, I'll take the cash at these prices, thank you very much.
It creates a ceiling on the stock. It absorbs all that buying pressure. And let's not forget the other side of this, the dilution. Redwire also has a $250 million at-the-market program.
Meaning they can print new shares and sell them right into this rally to raise cash.
And they need the cash. Their liquidity was only around $89 million in Q3. If you're going to ramp up for a massive missile defense program, you need working capital. You need engineers, materials, clean rooms. That costs money up front.
So they're likely going to use this stock surge to sell more shares.
Which dilutes existing shareholders. So you have a dynamic where the retail investor is buying the hype, while the company and its backers are selling the stock to fund the operations.
It doesn't mean the company will fail. It just means the stock price might not reflect the business success for a while.
Not with that supply overhang.
So we've established the government is a flaky customer. We've established the financials are tight. If I'm an investor, I'm desperate for some diversification. Does Redwire have anything that isn't tied to a congressional budget vote?
They do, and this is where this story gets a little more sci-fi, but also potentially much higher margin. They're hedging with what we can call space pharma.
I've seen the photos of the pillbox.
Right, the pharmaceutical in-space laboratory. They've flown 42 of these things, and they're partnering with huge heavyweights. We're talking Bristol-Myers Squibb, Eli Lilly.
And the whole pitch is that you can make better drugs in zero gravity.
That's the idea. On Earth, gravity causes problems when you try to grow crystals. In space, you can grow these larger, more perfect protein crystals. This can help pharma companies make drugs that are more stable or more concentrated.
So you can turn a drug that's currently a 3-hour IV drip in a hospital
into a simple injection you do at home. That's the holy grail. And the economics are totally different. If Redwire helps Eli Lilly unlock a blockbuster drug, the margins on that are pharma margins, not the razor-thin margins of building satellite parts.
It's a true commercial revenue stream. And speaking of diversification, they also have that drone division, which seems completely separate.
That came from their acquisition of Edge Autonomy. They make the Stalker and Penguin drones.
And these aren't concepts. These are in the field now.
They are combat proven. The Stalker is used by the U.S. Army. The Penguin is being used in Ukraine. This is crucial because it puts Redwire in the tactical defense bucket, not just the strategic space bucket. Even if NASA delays a mission, the Army still needs drones for the battlefield today. It provides a bit of a revenue floor.
Okay, let's try to synthesize all this. We've covered a ton of ground. We have the Golden Dome contract, which is a huge validation, but it isn't guaranteed cash. We have the space plumber monopoly with solar and docking. But we also have a messy balance sheet and insiders who are selling with a sense of urgency.
It really is the Redwire paradox. If you look strictly at the tech and their market position, they're indispensable. You can't build the next generation of base architecture Axiom Station, the missile defense shield without Redwire's IP. They are deeply, deeply embedded.
But if you look at the stock as an investment vehicle,
It's fraught with volatility, that 29% jump we're seeing today. That's driven by the dream of that $151 billion figure. But the reality is that Redwire is currently unprofitable, they're relying on dilution to keep the lights on, and their biggest financial backers are taking chips off the table.
it feels like the market is pricing in the absolute best-case scenario today.
While the insiders might be pricing in that it's going to take 5 years to actually see this money scenario.
Which is a very real possibility.
Right.
The shutdown proved that even signed contracts don't mean immediate cash. These huge defense programs are notorious for long lead times and bureaucratic delays.
So for the listener who's staring at that vertical green line on the chart and feeling that FOMO kicking in,
Yeah, what do you tell?
I would just say, look very closely at who is selling to you. The technology is real, the demand is real, but you have to ask yourself, are you comfortable holding through the volatility of government budget cycles? And does it bother you that the people with the most information, the insiders, are selling hundreds of billions in stock right as the so-called good news hits the wire?
That is the question I just can't shake. And I want to leave you with one final thought to chew on. We know insiders sold heavily in January, right before or during this hype. Do they know something about the timeline of the Golden Dome task orders that we don't? Are you looking at a contract that won't pay out real revenue for another 3 years? Or are they just cashing out before the space economy goes through its inevitable growing pains?
It's the ultimate gamble. You're betting on the infrastructure of the future, but you're doing it in a market that demands quarterly results right now.
Redwire is definitely one to watch, but maybe double-check your parachute before you jump in. That's it for this deep dive. We'll catch you next time as we unpack another market mover. Stay curious.
See you next time.